Hello, Marc Ostwald from ADM Investor Services International with some thoughts on central banks, above all given some signs of stress emerging in the US money markets and the failure of the ECB's first TLTRO3 operation. But let's start with the United States. Obviously, we had this rate cut as expected this week. We had a slight shift in policy signaling from the Fed to something which is basically quite nebulous and fluid, basically just promising to act as appropriate without giving any commitments to further rate cuts. But in the meantime, even before we had that Fed meeting, we started seeing some signs of distress in the US overnight repo market. Now, the overnight repo market, or the US repo market, amounts to about $2 trillion. So it's not exactly the smallest in the world. It obviously has colossal implications for Federal Reserve policy and the state of financial conditions. Why precisely we had the spike is not necessarily that clear yet. It is definitely a combination of the drain that I've mentioned over a number of weeks of the Treasury basically rebuilding its cash balance at the Federal Reserve, corporate tax rates, which are always very hefty in September, repayment of US Treasuries and a very large volume of US corporate issuance. But be that as it may, we basically found the New York Fed to be asleep at the wheel on Monday. So when we crept up, jumped up on that rate to 4.5% on Monday. And then on Tuesday morning at an opening bid saw a quote of 10%, 7%. When we had a Fed funds rate target at the beginning of the week of 2 to 2.25, there were clearly some problems which eventually the Federal Reserve reacted to. Causality, a lot of it is actually to do with some of the facilities that it's got, particularly for overseas central banks, to repo some of their treasury holdings, which are held at the Fed, which are FX reserves, back into the Fed, which they have a high incentive to use when you've got the Fed funds rate target well above most of treasury yields. But that's not really the point. The point here is we've got a malfunction, and the Federal Reserve really needs to start thinking a lot more about what it's doing. How does this play out in terms of market stress? Well, let's move to my next chart, because I think there's an important point to make here. This isn't like 2008. 2008 was a case of a lot of banking sector repos basically being backed by debt, which we discovered was worthless, even though it was wrapped up with insurance, which purportedly made it AAA. It's not quite the same, and we can certainly see that in the FRA, 3-month FRA versus overnight index swap rate, which has spiked higher. Part of it's due to the rollover, but it is again a reminder that this is not a sign of stress in the banking sector, but rather a glut of treasury collateral in the market and a shortage of bank reserves, partly due to the Fed's quantitative tightening. Last but not least, we're going to keep an eye on this, but last but not least, I turn to the ECB. This is basically a chart to highlight the point that basically for quite some time now, the use of the deposit facility at the ECB has been dwindling. And the big problem with this week's TLTRO3 operation, where there was only a 3.4 billion take-up against expectations of anything between 20 and 100, was that basically banks had repaid 31.8 billion at the beginning of the week of TLTRO2. So that basically meant a 28 billion net drain. And that leaves us in a situation where we have to question the new parameters with the tiering of deposit rates, which comes into effect on October the 30th, and ask whether there's going to be some unintended consequences. Because if this is so complex that banks need more time to actually work this out, then it's probably going to have some unintended consequences. So stress in money markets needs to be far more carefully watched than we have been of late. And those are the thoughts for this week.